Web. This is Bloomberg.
Earlier, markets couldn't decide. Now they are decidedly down. This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Ferro. Moments away from the start of the trading day, and we have found a direction. It is lower. It is in the red. NASDAQ down 0.6%. You can see S&P down 0.3%. In the bond market, you are seeing those two-year yields continuing to climb higher as people reassess what it means for a hawkish Fed. 10-year yields also rising 3.6%. A bit of dollar strength generally, although the euro is gaining a little bit of ground, but still, wow, 98 handle, talking about euro devaluation, and crude a little bit higher. Really a mixed picture, though, as people try to understand how much more pain there needs to be in order to get something of inflation coming lower and a Fed that feels comfortable enough to pause. Joining us now with a look at the stocks moving ahead of the opening bell, Abigail Doolittle.
Well, Lisa, that move in yield, it's really just stunning. Either that 10-year yield now at 365 or the two-year yield above 4%. It's just incredible, really weighing on tech in particular. That's taken Meta Platforms lower. Earlier, it had been higher, of course, on the news, the Wall Street Journal report that came out yesterday that they are planning on cutting costs by 10%, allowing for job attrition. Morgan Stanley analyst Brian Nowak says it will help the bottom line. Oh, there we have a small gain. Let's see what happens on the day. ExxonMobil higher with oil up, as you just outlined, up 1.6%. Of course, the down dollar helping oil on the day. It's interesting, though, that the demand outlook, based on what the Fed's saying, you would think that maybe oil wouldn't be down, but it is. Robinhood up nearly 9%. This, of course, is the SEC is allowing payments for order flow, basically allowing them to take payment to send retail orders to other brokerages. Very controversial, but it's sticking in place, at least for now. And then finally, here's a big laggard. Darden Restaurants, think Olive Garden, Longhorn Steak, down 2%. They missed comp. Both of those companies, those restaurants missed. They did hold the outlook, so maybe they're seeing something brighter at the end of the year. A little bit of a different picture than what Fed Chair Jay Powell was talking about yesterday, Lisa.
Thank you so much, Abby. I'm sure we'll get a full analysis of the breadsticks tomorrow. We'll discuss it, I'm sure, on Bloomberg Surveillance. Right now, tech stocks extending their declines after closing at their lowest level in more than 2 months. Bloomberg's Ed Ludlow joining us now for more. Ed, tech has gotten such a beating. How much further?
Yeah, I mean, we're modestly lower, 0.2% on the NASDAQ 100, 0.3% on the Philadelphia Semiconductor Index. The NASDAQ 100 reacted to power with gyrations, right? And then we closed at an early July low. The surprise was not 75 basis points. It was the forecast from officials of 4.4% rates by the end of this year and a terminal rate of 4.6%, which calls into question global growth, right? Many of the laggards in recent weeks have been mega caps, strong balance sheets, entrenched market positions, but they're concerned about inflation and global growth. Even with valuations coming down, we see price pressures. Bloomberg's Emily Chang spoke to Microsoft CEO Satya Nadella in the last 24 hours, and this is what's top of mind for him right now. Take a listen.
The constraints are real. Inflation is definitely all around us. And different parts of the world have different type of economic growth, but the constraints, I think, are being felt by everyone.
The constraints are real, and how big a story has the stronger dollar been for names like Microsoft, who have seen their earnings hit from that regard? The other thing we continue to see is more speculative corners of the market get hit, but I just cannot get over how much decline we see in the mega caps, who time and again, analysts talk about being more resilient in a difficult macroeconomic environment, but we are still continuing to see pain, and we worry now about that R word, recession.
Ed Ludlow, thank you so much. The big banks grappling with that as well, and looking to rebound from 2 days of steep losses. The Fed's jumbo rate hike sending the sector down more than 2% yesterday alone. Bloomberg's Katie Greifeld joining us now for more. Katie.
Well, Lisa, it's definitely the Wall Street banks versus the central banks. And looking at my first chart here, it's the big banks that are losing the battle. Like you said, the sector just falling more than 2% after the Fed's third straight 75 basis point hike yesterday. We're trying to regain a little bit of ground this morning, not doing too well, though. But for all the talks of higher rates hitting tech, you just heard it again from Mr. Ludlow there, banks are doing even worse. If you look back since the first hike of this cycle all the way back on March 15th. Communication stocks, of course, have absolutely cratered, but it's the financials that are lower by almost 14%, underperforming the tech sector even. And that's interesting for a few reasons, Lisa. One of the biggest being that higher rates normally thought to help bank stocks. That's not the dynamic this time, as you can see from this chart. The 10-year Treasury yield in yellow there, breaking apart from financials. A potential reason why is that even though you do have higher long end rates, it's the yield curve that's deeply inverted. So it makes it a little bit more difficult to borrow short and lend long.
Katie Greifeld, thank you so much. And talking about banks, big bank executives facing yet another second day of questioning on Congress, returning to Capitol Hill after JP Morgan's Jamie Dimon took a firm stance on fossil fuels. Take a listen.
Does your bank have a policy against funding new oil and gas products? Mr. Dimon.
Absolutely not, and that would be the road to hell for America. We aren't getting this one right. Investing in the oil and gas complex is good for reducing CO2.
Bloomberg's Sonali Basak joining us now for more. Sonali, really interesting, wide-ranging discussion. It comes at a time of a real pivot in the economy with the Fed. How much more do you think that the banks are going to weigh into this? Do they want to see higher rates? Do they not? What's their outlook?
Well, it's that balance with employment. And you see in the start of the hearing today at the Senate, there's another issue. Everything is politics, Lisa, but there's another issue that is coming front and center right at the beginning. There is a photo, a picture, a board, if you will, behind Sherrod Brown, the chairman of the committee, that shows CEO to pay ratios, which, as we know, pay has gotten much higher over the last couple of years as the banks have done well, but are now more under pressure. So those ratios are clearly of concern. Remember, some of the banks that are testifying today have raised their minimum wage. They've cited that in their prepared remarks. We saw Wells Fargo really under fire yesterday, really coming under fire for starting to let go of workers. In Iowa, for example, that's 9 rounds of firing. They were very specific about it yesterday. So you have lawmakers that are worried about their communities, about those jobs, in addition to inflation. So at one point, Lisa, I know you were paying attention to this, the Fed being politicized, every action that we see of real concern here. And at one point, you saw lawmakers ask the bankers, particularly Jamie Dimon, whether the Fed's dual mandate was appropriate. And while Jamie Dimon said that it was appropriate, he said it should be monitored. I want to do a little bit of a pivot here as well, Lisa, because at yesterday's hearing, you had lawmakers very concerned and very upset that the bankers were there, but the SEC was not, that Chairman Gensler had not testified to that committee. And what you're seeing today, I want to pivot a little bit to this Bloomberg scoop of the SEC really leaning away from really a full-on ban on payment for order flow deals. If you take a look at that there, that has an immediate impact on the stocks. You have Robinhood jumping almost 10%. You have Virtu jumping more than 7%. And this is something that may still see changes. But again, how much things might change for Wall Street on the regulatory front is clearly under fire, as everything they do is enormously politicized.
Sonali Basak, thank you so much. BlackRock is seeing a difficult path for central bankers ahead, writing, quote, "This is the most difficult economic environment to navigate in half a century. Even more than the financial crisis, there's no desirable outcome at this stage. The question is, which is the least bad?" Joining us now is BlackRock's Jean Beauvais, who penned that rather dire missive. Jean, why would you say that it is worse than the financial crisis in terms of the depth, in terms of the duration, or in terms of the unpredictability and how to deal with things?
Good morning, Lisa. Great to be here. You know, the financial crisis was a very difficult situation. I don't want to underplay that by any means, but in terms of what needed to be done, it was a whatever it takes kind of situation, and we ended up, seeing powerful measures being deployed. And at the end of the day, you know, the remedy, the cure was the right thing for growth, was the right thing for inflation. Took a long time, but that was a pretty easy set of policy to figure out what to do. Right now, we're facing conflicts between stabilizing growth and inflation like we haven't seen in 40 years at least. I think they are of a nature we've never seen, in fact. And that conflict makes the decision, the choice, far from trivial and much more difficult than they were in the financial crisis.
Do you think that markets are accurately pricing this in?
No, we don't think so. And I think the central bankers are starting to move in that direction of reflecting this very sharp trade-off, but they're not yet there. So both the central banks are not reflecting that, and the markets are not reflecting that. If we want to stabilize inflation quickly on a path that looks like what the path it's forecasting for inflation, that would require a cost on activity and employment that is very significant. We think it's a 2% decline in GDP, in activity, and 3 million jobs that will need to be lost in the U.S. That's not reflected in markets.
Okay, so that's something that you also don't think that central banks are reflecting in their rhetoric. They're getting a little closer, but we heard yesterday from Diane Swonk, they're still in a little bit of a fanciful land when it comes to how deep that pain is. You said markets are not reflecting that either. What would the consequence be for, say, the S&P 500, for, say, big tech companies, if this realization does start to settle in?
So I think what we are heading for now, and nothing in the decision yesterday in the press conference has dissuaded us from this view that we're on a real path towards over-tightening. So the central bank is going to be looking for evidence that inflation is decisively on the path to 2% before questioning any of their plans at this stage. The problem is inflation will only really come down once we've seen very significant decline in activity. So I think we have a clear sequencing from here. Over-tightening, then we'll see the economic damage in second, and then only after that, and after many months of lags, we'll see the inflation impact. So that means that for now, I think this is going to be putting pressure on broad markets, and any interest rate sensitive part of the stock market will be most directly impacted. And I think that will continue for the next few months. That's why we're underweight DM equities for the time being. And we'll need to see, central banks starting to question more fundamentally and bringing these trade-offs more explicitly before we see a more constructive backdrop.
And this is really raising a question when you say interest rate sensitive parts of the equity markets. Do you see 10-year yields going substantially higher from here? Or are you starting to see this as a good place to hide? And this has really been a big point of contention over the past couple of days.
Well, the moves have been very significant. We've been having a very high conviction for the last, many months, even I would say the last couple of years, that very high conviction underweight for 10-year or longer-term treasuries. That has been now reflected a lot more in the price. We still think that that's some room to go. So I don't find that necessarily now tipping and becoming more attractive. The inflation story will still surprise on the upside for some time. I think the Fed has not done surprising moving in that direction. I think now we're pricing 4.5 maybe as a terminal rate. I think the risks are to the upside of that for now. So that's an environment where I would see still yields moving higher from here on a 10-year.
So there's another issue here that's raising a lot of angst for people, which is the United States is looking worse and worse as the Fed continues with its rate hiking path, but it looks a lot better than other places, which is the reason why the dollar keeps gaining. At what point does that switch? At what point does that become less of a clear-cut dynamic?
I think there are two key drivers of the dollar, like in general. I mean, there's the interest rate differential with other regions, and clearly this is at play here. And then the other is the broad risk, the global risk-off, risk-on sentiment. Right now, I see the two drivers working in the same direction. So we have the Fed surprising, very aggressively moving with rate hikes, going on the over-tightening, that's supporting the dollar. And the second is that is also contributing to the global risk-off, which is also, adding to the bid to the U.S. dollar. So I think that's going to switch only more or less very similarly to the broad market risk sentiment. I think it's going to be when we get more clarity on the size and extent of this downturn, which we think is real, but how much we'll need to see. And when we see the central banks, the Fed in particular, as I said before, start to acknowledge the trade-off that they need to manage and navigate. So once we get a sense that this is happening, I think we'll see some of the pressure on the U.S. dollar cooling off. But until then, I think this is pretty much two big drivers working in the same direction.
Jean Boivin, we'll be continuing this conversation. You'll be sticking with us. Up next, a marathon week filled with global central bank rate decisions. Take a listen.
We came to the conclusion that it's the right time to tighten monetary policy and especially to go from negative to positive short-term interest rates.
And then, of course, the Swiss franc still sold off in the wake of that decision. That conversation coming up next from New York. This is Bloomberg.
The inflationary pressure in Switzerland increased. If you look at our inflation forecast, slightly different, even if you include the interest rate hike. So we came to the conclusion that it's the right time to tighten monetary policy and especially to go from negative to positive short-term interest rates.
Everyone's hiking rates, it seems, except for one, the Bank of Japan. A host of central banks out with rate decisions today. Norway, Switzerland, Taiwan, and the United Kingdom all following the Fed with hikes. Bloomberg's Michael McKee is back with us for more. Mike, with the exception of Japan, regime change across the board.
Regime change across the board continues, and we even had one more. South Africa just raised its central bank rate by 75 basis points. And it's remarkable not just for the fact that they're moving higher, but they're moving higher in very big chunks following the Fed. The biggest reaction, of course, is always in the currency markets. The pound gained a little bit back, but it's still way down, and it's starting to lose its gains. We're seeing the Swissy down against its biggest trading partner, the euro. As you mentioned, the Bank Bank of Japan did not make a change. We're still seeing weakness there because the Japanese are using this as an opportunity to get inflation up. They would like to see more inflation. They're the only country in the world that really wants that right now. And then finally, the Norwegians are down against the euro because they too are raising rates, and that has an impact on oil prices. But the old saying, it's our dollar but their problem, also rebounds in this situation to the United States, because when the blue line goes down, the yellow line goes down and the white line go down, and the blue line is the exports that the U.S. Exports to the rest of the world. The white line, the Bloomberg Dollar Index, and when the dollar falls, we sell less because our products get more expensive, and that means there are jobs lost in manufacturing. So even though the dollar is really strong, its long-run impact isn't always going to be great. And so the dollar and the Fed have to figure out, what are they going to trade off here? And what we're getting is a global recession instead of an improvement in the terms of trade. If you look at the British and the European odds of recession, they've gone way up. Europe now 72%. And what is a global recession going to do for anybody? Not a whole lot, and it isn't going to help the United States either. So then the question starts to arise, do you need to do something about it? The Japanese intervened today. It'll probably fail. There's not enough yen in the world to move that market for the Bank of Japan. But do we need some sort of overall move on currency? That's a question that will be asked more and more.
Yeah, the whole idea of coordination between the central banks. Michael McKee, thank you so much. BlackRock's Jean Bovin is back with us. And Jean, I want to start with Japan and the move overnight and their commitment to yield curve control as everybody else moves in the opposite direction. How close are we to an accident that forces the Japanese officials' hands?
Well, that's very difficult to answer. You know, it's under control until it's not. It's one of those things, and it is the case that there's a lot more chatter about whether they're going to be able to sustain it or not, and I guess market participants betting on this one way or the other. I think that the Japanese situation is very different, as was just explained. Inflation is a good story there. The need to change policy stance is not at all the same as you would see elsewhere. So it becomes more of a global pressure coming from interest rate differentials and currencies, a market participant. I think, the resolve is there, but when it breaks, it's very difficult to predict. I think even when the Bank of England went off the European monetary system, it was not necessarily obvious before it happened, so difficult to say.
And the problem is that Bank of Japan is an outlier in one sense, but a trendsetter in another. Evercore ISI weighing in on Japan's FX intervention, writing, quote, "The intervention shows Japan wants to limit yen weakness, but not at the price of changing monetary policy. It is not alone. China's People's Bank of China is also staying dovish and tolerating FX weakness." At what point, Jean, based on some of the interventions that we're seeing around the world, at what point is there sort of a trigger that reaches? Where does something break? And that's something that we were discussing yesterday. Are we reaching any breaking points in the currency realm?
I think, to my mind, the breaking point is not immediately about some kind of financial pressure or breaking points. I think it's more the fact that we're seeing very significant dollar appreciation that is putting pressure on the global economy in a significant way. I think it's useful to remember 2013 when the mere talk of starting to slow down the purchase of the asset purchase from the central bank created a massive tantrum, as we know, in the emerging market world. We've raised rates in the U.S. by 300 basis points over the course of a few months, and we haven't seen yet those kind of cracks. So I think this is where when we're going to start to see that, then that could trigger a bigger adjustment, maybe discussions about intervention at a bigger scale and some form of coordination. But surprisingly, I guess, we haven't really seen that yet.
Jean Boivin, thank you so much for taking the time. Fascinating concepts in a moment that seems historic on many levels. Regime change in the yield space, regime change in the inflation space, regime change when it comes to a lot of leadership across the world. Coming up, the market move events that you need to be watching. That's next in our trading diary. Right now, markets are a little bit of a risk-off tone as yields continue to just edge a little higher. This is Bloomberg. This is Bloomberg's The Open. I'm Lisa Abramowitz in for Jonathan Ferro. We are 25 minutes into the session, and the gloom is sticking. Almost 1% down on the NASDAQ, and the S&P down nearly 0.7%. Yields continuing to climb, reassessing the hawkish resolve of this central bank in the U.S. as well as around the world. Time now for your trading diary. What you need to be watching this week: FedEx and Costco earnings coming after the closing bell. We'll get U.S. PMIs on Friday. Plus, we'll hear from Fed Chair Jay Powell, talking perhaps more about the hawkish move that they're making. Then looking ahead to next week, Fed Speak continues with Collins, Bostic, and Mestre on Monday. Plus, Powell, Evans, and Daly speaking on Tuesday, the return of Fed Speak after the quiet period. This was a countdown to the open on a day where we're seeing just one hawkish move after another for central banks around the world. This is Bloomberg.
financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Thursday, September 22nd. Here are the top market stories that we're following for you at this hour. Okay, now do you believe the Fed? Jay Powell says employment pain is needed to crush inflation. Stocks sink, yields jump, dollar inches higher. And the global liquidity squeeze, just 4 central banks hiked over 200 basis points in the past 24 hours, putting a big roadblock on the path for risk assets. And Japan's blockbuster intervention. Japan props up the yen for the first time since 1998 after the BOJ says no to rate hikes. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Well, that was a fun 12 hours that we just saw. How high can we push these rates? I mean, that really feels like that's the question.
Yeah, it's been quite exciting from a macro point of view, hasn't it? We've been waiting for this moment to come. The Fed has now indicated that it is firmly on the path to basically cause a US recession. The words are fairly unequivocal. And I guess if you look at today's claims number, maybe they've got a reason to want to slow the labour market down a little bit. But as you say, it's not just the Fed. Bank of England, 50. You've got the S&P by 75, and everybody seemed disappointed with that. Norges Bank, 50. It just all starts to tot up, Alex. And that doesn't include the QT.
Right.
Either.
Yep, it doesn't. And just talking about where you're going to see the pain, just to highlight, mortgage rates in the U.S. jumped to 6.29%. Haven't seen that since October of 2008. The Fed talked about that yesterday. They do have to see housing really roll over, and we are seeing, at least for the mortgage rates, signs that that could happen.
Yeah. But again, this process seems to be unfolding relatively slowly. The U.S. economy still looks like it is in fairly good shape. The labour market looks like it is in fairly good shape. The Fed's going to have to go hard. How hard? I don't think we still know, and I don't think the Fed knows either. But what is clear, Alex, is that 75 basis points is not the end of it, and that the Fed is determined to cause pain for the U.S. economy. So that's how we should now be thinking about this. It is going to have to engineer a significant slowdown. So the Federal Reserve's decision to raise interest rates by 0.75 percentage point certainly shows the market that the battle for inflation against inflation is far from over. This was Fed Chair Jay Powell laying out his struggle.
Strongly committed to bringing inflation back down to our 2% goal. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage point, bringing the target range to 3 to 3.25%. And there will very likely be some softening of labor market conditions. What we think we need to do and should do is to move our policy rate to a restrictive level that's restrictive enough to bring inflation down to 2%. We've just moved, I think, probably into the very lowest level of what might be restrictive. We probably in the housing market have to go through a correction. The median for the year end suggests another 125 basis points in rate increases.
Pain, pain, pain. That is the message, the very clear message, the unequivocal message to financial markets, to the housing market. So that takes us, Alex, to our question of the day. What is the Powell pain trade? For that, let's bring in Anastasia Amoroso, iCapital's chief investment strategist. Anastasia, how do you trade this? What is the pain trade for Powell if he is going to cause that pain?
Well, I think investors need to take him at face value, and that he's trying to engineer a slowdown in inflation. To do that, he has to crack not just the economy, but to crack the labor market. And if you crack the labor market, that in turn is not good for the economy. Whereas before the trade was to prepare for a soft landing, I'm not so sure that's the trade now. And what the markets really need to do is price in a recession, because it seems like that's what a weakness in the labor market would ultimately cause. So, unfortunately, we've been in this trading range for a while. 3,700, 3,800 to 4,300. And I think we may need to see a break below the bottom of that trading range to really find deep value, dirt cheap value in equities. And we're just not there yet. So the trade for now is to actually be defensive and, to get paid while you wait for sort of this bottom in the market. And the good news, if I could just, finish this on the good news here, is that there's a lot more ways to get paid. When was the last time we saw, when we get there, 4.6% on, cash? You have to go back to 2007 to see that. So finally investors have some yield options, and a lot of them are starting to be almost risk-free.
Okay, what's your favorite one?
Alex, it's pretty boring, to be honest with you, but if you look at the 2-year Treasury note that yields you north of, now more or less north of 4%, I would be a buyer of that, and it's short duration. Even if the Fed keeps going higher a little bit, I don't think you're going to have a significant negative mark-to-market. You know, you could look at really boring things like CDs, for example. Again, this is something that we've not talked about since 2005, 2006, but you look at a 1 or 2 year CD and you're looking at 4% or 4.1%. So I think investors can start doing those sorts of ladders of really high quality, virtually risk-free fixed income. So I think that's interesting. But you obviously, you know, if you're doing 4%, you're just barely covering the core PCE. So you may need to add something else to the portfolio. And I like barbelling this with the high yield trade, for example, where the yields are now north of 8.6%. And when those yields and those spreads get to the 8% or above levels, historically that tended to be a good point to buy high yield, and the forward returns historically have been quite positive. So I like that for now, maybe perhaps as a placeholder instead of equities, while we still wait for sort of this washout event in equities.
How long do we have to wait, Anastasia, for this whole process to unfold? We still haven't seen, in some ways, the liquidity squeeze kicking in. We're only getting into still the process of QT. Rates are continuing to go higher from here and could go significantly higher from here. How much more pain is there still to be felt?
Yeah, I mean, I think something needs to break, to your point, and we need to feel this pain. And I think this could be a 3 to 6 months process. And I say this because the Fed wants to get to that 4.6% rate by February. I mean, they're going to do the bulk of that by the end of the year. And I think what's likely to happen in the next few months is, if you look at the economy, it's already on the brink. It's already sort of teetering on this break-even level if you look at things like PMIs and new orders, for example. But we may very well see in the next few months, just given the amount of tightening in the economy, we may start to see more layoffs. We may start to see the initial jobless claims goes up. And I think once you start to see that, that's when the markets will finally start to price in greater recession probabilities. And here's the thing, Guy, it's not like we need to be in a recession or see a recession. We just need to price it in. So to the extent that the markets price it in the next 3 to 6 months, I would think the value would finally emerge in equities.
Oh, that's interesting. So basically, as long as the market can do the Fed's job for it, maybe they have a little bit more wiggle room. Does that imply the potential for a Fed soft landing?
I mean, maybe. I think we might still end up with some sort of at least a mild recession, but I guess the point that I'm trying to make is that the markets will price it in before that, even when we start to see recessionary job numbers and then the recessionary economic numbers. Maybe the market at that point does not need to move lower still. It will have already priced that in. I mean, that's typically what happens. But I think the Fed is resolute in bringing down inflation. I think they've sort of conceded that in order to have lower inflation, they need to have higher unemployment rate. There's just no way around that.
Anastasia, should investors have any money in crypto right now?
Look, long-term investors should be looking for, value in these secular, sort of growth ideas. I think it is a little bit dead money for the near term until we see either a Fed pivot or we see an improvement in economic activity. But, if I take a step back from sort of trading in the next few weeks, the next few months, and I take a step back and look at the next 3 to 5 years, this is the time now, maybe the next 6 months, where you want to be allocating things that you do have belief in over the long run. You want to buy things when it feels terrible to do so, and I think it feels pretty terrible in things all unprofitable tech and things all crypto at the moment. So if you have that 3 to 5 year mindset, you want to be adding to it, but I wouldn't have any sort of expectation for significant positive returns in the near term.
Really good perspective. I do feel like how long you're invested in definitely matters more now than I feel like it ever has in the last 15 years. Anastasia, great to see you. Anastasia Amoroso, iCapital Chief Investment Strategist. Thank you for joining us. Well, coming up, you got the SEC deciding on what to do about a controversial practice on Wall Street, and that has shares of Robinhood surging. We're going to get those details for you next. This is Bloomberg.
when the Fed makes its call.
A unanimous Fed raises the benchmark rate 75 basis points.
Bloomberg is there with live coverage.
We anticipate ongoing increases will be appropriate.
The market's responding to this, as you might expect.
And instant expert analysis.
Do we want this Fed to force a recession?
They're saying that forward guidance is dead. It is very not dead.
We keep being surprised at how durable inflation is.
The risk is skewed to doing too much.
They're choosing the lesser of two evils.
Nobody covers the Fed like Bloomberg, your global business authority.
Our shares of Robinhood jump in today as the SEC stopped short of banning payment for order flow. That's a source of major revenue for the brokerages. Want to bring in Bloomberg Sonali Basak joining us for more. So they didn't abolish it altogether. Did they tweak it or make changes?
Now, these are according to people familiar with the matter, to Bloomberg's Lydia Bayoud and Catherine Doherty. And the idea here is that they're not going to ban it completely, but they will make some changes in the future. Remember, there's a host of things that they were discussing, order-by-order auction mechanisms. But what it all comes down to at the end is, does this really provide execution for clients? Is there enough clarity? Is there enough disclosure on what the clients are getting at the end of the day? But yes, the idea that there won't be a wholesale ban on this, you see Robinhood shares shooting higher because so much of their revenue comes from that payment for order flow. And then you also see Virtu Financial shares shooting higher as well. Something interesting, those the market makers are the ones that do the paying. They don't receive the paying, but they do get volumes by means of that. So at least a big change here, not underway, or at least as big as it could have been.
Sonali, so if it's not going to be banned, everything else is pretty much at the margin. How embarrassing, how difficult is this decision for Gensler and co? There was a lot of sound and fury around this, and we're basically going nowhere.
Well, I think this is a great question because remember, there's been a lot of discussion about the SEC over the last couple of days. The SEC has already come up again today when you look at the banks testifying at the Senate Banking Committee. And remember, that hearing has only been going on for about 45 minutes, Guy. And so there's a lot on the SEC's agenda right now. The House Committee was very upset that the chair had not testified there. But the Banking Committee is upset about other things. They're upset about, for example, climate change, which now the banks are answering questions to. I do want to shift to the bank hearings for a minute here because, again, we expected this, that it could be a little contentious, a lot of political issues at play here, but you do have Sherrod Brown out of the gate. First question, before they even gotten started with the bank CEO testimonies here, telling Charlie Scharf, is Wells Fargo too broken to fix? Whereas Pat Toomey is saying that they're so caught up in political issues that they risk on both sides of the aisle becoming public utilities. So it is going to be another long day of hearings ahead and a lot of rhetoric. The question is post-midterms, what do those rules really look like for these banks? And to your point, as we've been talking about the brokerages that align with them.
Absolutely. If you want to follow the live blog that is taking place on the Bloomberg as a result of the hearings that are happening right now, you can see live pictures at TLIV on your Bloomberg. Sonali, great stuff as ever. Thank you for updating us, Sonali Basak. Coming up, the UK Prime Minister Liz Truss is looking to settle the issue of the Northern Ireland Protocol dispute before the 25th anniversary of the Good Friday deal next year. We're going to get some reaction from Alan Taoiseach, the Prime Minister, next. This is Bloomberg.
We both are committed to protecting the gains of the Good Friday Agreement in Northern Ireland. I'm looking forward to hearing what's on your mind and how we can continue to cooperate.
I'm looking forward to discussing the Belfast Good Friday Agreement and how we make sure that's upheld into the future.
President Biden and the UK Prime Minister Liz Truss talking about the Good Friday Agreement after their bilateral meeting in New York yesterday. Let's get some reaction to what came out of that discussion. Michael Martin is Ireland's Prime Minister, Ireland's Taoiseach. He joins us now. Taoiseach, thank you very much indeed for your time. Prime Minister Truss says that she wants to have the issue of the Northern Ireland Protocol squared away by the 25th anniversary of the Good Friday Agreement. How hard, how firm do you think that deadline is?
Well, first of all, I welcome what I detect as a renewed sense of determination on all sides to get this issue resolved once and for all. There's a more immediate deadline in October in terms of the restoration of the Northern Ireland Executive and Assembly, which is critical to the sustainability and of the Good Friday Agreement itself. And there's an obligation, I think, on all politicians in the North, and particularly those who are refusing to take their seats right now because of issues pertaining to the protocol, to make every effort to make sure that a second election is avoided and that the institutions of the Good Friday Agreement are activated, particularly the Assembly and the Executive. Now, at the weekend I would have met with the British Prime Minister and we had an initial constructive meeting and there is a shared determination to get the issue resolved. I know that the Prime Minister would have met with the President of the EU Commission, Ursula von der Leyen, and again I would have been in touch with President von der Leyen also. And again, Europe wants to resolve this. Maroš Šefčovič has been very clear about this and has shown flexibility. So in the context of the very sad passing of Queen Elizabeth, at the weekend I met many members of the British Cabinet, and many world leaders there, and people took a step back and reflected, given the late Queen's contribution to diplomacy and to better relations between Britain and Ireland, and particularly in her historic visit to Ireland in 2011, that many people are saying we've got to really give this a very determined go, and we've got to get this resolved. And it's in many ways to vindicate the work of previous generations who brought peace to the island of Ireland through many endeavours.
It sounds like then the tone is constructive and positive and not contentious. Is that a fair statement, or can you tell us about the tone?
I think the tone is determined. I would not underestimate the difficulties in getting a resolution. There are some significant issues to be resolved, and the devil is in the detail of this. But where there's a will, there's always a way. I would have had concerns over the last year about the absence of a will to get this resolved. I'm clear now that there is a will to get it resolved on all sides, and where there is a will, there's always a means to doing that.
Taoiseach, we're going to see the budgets, I think, presented to the Dáil next week. The issue of the cost of living crisis that we're all experiencing absolutely front and centre. What can the Irish people expect in terms of assistance from their governments? Are we going to see caps like we've seen elsewhere? What can be done to alleviate the suffering?
Well, we've already allocated about $2.5 billion between last year's budget and measures we took during this year to alleviate pressures on households. That said, the prices are going to escalate further and have. So next week we have a budget which will determine the expenditure and revenue situation and framework for the next 12 months. But parallel with that, we will have a cost of living package that will have immediate application to this calendar year of 2022 and financial year, and with measures to alleviate pressures on households and families, but also to protect jobs, because we are conscious quite a lot of SMEs are facing costs the likes of which they have never experienced before, not even in the late 1970s. So this is a very, very serious crisis. What we would say to people is we got through COVID in Ireland and across the globe. We did intervene in an unprecedented way to protect jobs on that occasion and protect household incomes. we had a very significant bounce back economically, which was much faster than we would have had anticipated at the time. But so side by side with this economic recovery, we have this very significant issue now in terms of cost of living, which is impacting and will impact ultimately on performance, economic performance across the globe. So we have to help people first and foremost to get through this winter. That is the immediate target, certainly to the end of March.
When you take a look at getting through the winter, do you feel like this is, though, a structural issue and not a cyclical issue? This is a huge transformation in the energy industry that will last a long time. What if it's longer than the winter? How do you view it?
Well, I think we have to take it step by step. I think getting through the winter matters in terms of an energy crisis, in terms of costs are more, more impactful on people getting through a cold winter. And it gives us time for the medium term next year, for the medium part of the year to plan longer term strategies. The most fundamental strategy of all is to double down on renewables. There's a gap now between where we are in that respect and where we want to get to. So the years 23, 24, 24, 25, 25, 26 are critical years in terms of energy security and supply. We will be majoring in offshore wind in Ireland, and there will be very significant investment opportunities in offshore wind in Ireland. And we are commencing that process, and we have the legislative framework in place, the permitting system. European Union Commission is also liberalising the permitting situation to create an overriding public interest in getting offshore wind farms built faster than would have been the case. And I think that is the longer term strategic shift. What Russia's war in Ukraine has done, in my view, is to accelerate the move from fossil fuels to renewables. There is no doubt about that. And I think I see technologies, I see innovation moving much faster now to deal with that. And Europe has made it clear it wants to eliminate its dependency on Russian oil and gas.
Taoiseach, I hear what you're saying about the need to move quickly. Do you think you are moving quickly right now? It feels slow in terms of what we're seeing in terms of new turbines going in, the potential for Ireland's wind industry to grow. Do you think you're moving as fast as you could or should?
I would like us to move more quickly, and in all democratic states, we have challenges in terms of various processes that we have to go through. But on the East Coast now, we will see significant movement shortly in terms of consents and that. And a lot of the legislative and capacity has been built into the system now. The new legislation is particularly significant, which was passed last year. The creation of a new agency to oversee the maritime permitting system will also be significant, and in my view we will get there. Of that I have no doubt, but we want to do so in a structured way also, and there's lots of other issues in terms of connection to the grid and so on, which has been improved upon. So I'd like us to move as quick as we possibly can. There's a general view across Europe that our permitting systems need to be more nimble, need to be faster in ensuring that we can make that transition from fossil fuels to renewables more quickly. I would say that Ireland has been one of the more effective countries in terms of onshore wind and in terms of generating electricity through renewables. We have a very ambitious target now to 2030 in terms of getting that up to 80%.
Taoiseach, thank you very much. We appreciate your time today. Thank you for braving the traffic and spending some time with us. Thank you very, very much. Micheál Martin, Ireland's Prime Minister, thanks very much. But either way, it's going to be a long haul over the next 10 years to really change the energy mix in all over the world. All right, coming up, back to the markets. Japan just says, you know what, it's enough. They're taking steps to keep the yen from falling even more against the dollar. We're going to talk to the global head of currency strategy at Brown Brothers, Harriman Winthin. He is joining us next. Is this the start of global central banks fighting back against that strong dollar? This is Bloomberg. right, we're about an hour into the U.S. trading session. It is ugly out there in equities. I'm a little surprised we're not down even more because yields are really popping higher, particularly on the back end. Abigail Doolittle is tracking all these moves for us. Abigail?
Yeah, Alex, yields are really incredible, and this is the year produced by these rising